I gotta ask you guys a question though to start today. Did I give you guys my background and where I've come from? Did I do an intro when we first started these? I feel like a bad host. I don't think so.
I don't think with these.
I know you've referenced accounting.
Yeah, see it. My son would do this. He'd give me the weird stink eye. So I'm gonna spend this time and I'm gonna put you guys on notice that at the start of every one of these meetings, I'm gonna get a new person to introduce themselves. Cool. So I'm gonna do mine today. So just so you guys know where I've come from and where how long I've been in the industry and credentials and things like that. So I did my, oh, Lindsay, you're coming in twice?
I'm here now. Yes.
It's weird. I got another notification that you're joining.
Okay, I'm gonna go. I can use my computer on now.
Okay. You're gonna switch them. There we go. Okay. This is weird. Okay, so I was originally, okay, I'll give you way back. Originally born in Budapest, Hungary. My parents moved to Canada when I was 3. Grew up in Vernon. They went from Budapest to Vernon, so really weird. Grew up here, and then after high school, I decided, as most of my high school fellows did, that we wanted to get out of Dodge. We wanted to get out of Vernon because it's a small town. And then I did my degree at UBC. I did my degree in commerce and economics, and then I worked in an accounting firm for a number of years. Did not like accounting because it was horribly boring. So I went from doing my degree and being like, yes, this is exactly what I'm going to do, to note this is horrible. So then I went and I worked in insurance for almost a decade, and I worked with Great-West Life. So I knew the insurance side of things. And then I also worked after that in banking. So I worked at CIBC. And after CIBC, I came to work for White House. I've been with White House for almost 14 years. I came on as the general manager, but also did my brokering license at the same time. So I've been GM and a broker on my own, and with Sue and with Mindy for that 14 years. So that is my background. And so you guys know kind of a little bit about me personally. Dean probably knows a little bit about this, but so personally, I spent most of my 20s and 30s doing triathlon because I absolutely love the sport. It was very cool. But I retired because it gets very challenging. It's very tiring, and it takes up a pretty big portion of your life. So that was it for me. I kind of stopped in my, I guess, mid 30s. But I also play soccer. I love soccer. I love sports. I love skiing. I've taught skiing when I was younger, and I love golf. So a lot of my clients tend to come from those things that I've done in the past. So I wanted you guys to know that the real side of a person, like what are all of our hobbies and stuff, that side does tend to kind of filter into who you'll end up kind of seeing and meeting as part of just generally what you do, and those people come into that mortgage side. All right. So today you're probably wondering, what are we talking about? So in the first session, we did an introduction. Session 2, we talked about the history. And today we're going to talk about insurance. So you'll probably know that there's a bunch of different types of insurance that come into the mortgage world. I'm going to put it out to you guys. Name one insurance.
Manulife?
Okay, so Manulife is what kind of insurance? Like in general, what does Manulife do?
Mortgage
Benefits,
insurance?
life.
Like critical illness, disability, life?
Okay, so I think we've kind of nailed it into that one little spot. So Manulife, or some people know it as Manulife. Some people might know it as Manulife has a special product called MPP. Those are mortgage life insurance products. So they're essentially designed to provide or make a payment in case a person either dies or gets disabled or has a critical illness. So that's really kind of like the life insurance side of things. It protects either the client or the lender, and it allows for the mortgage to either be paid out or monthly payments to be made. All right, so that is not what we're talking about today, but that is a correct answer because that is one of the insurances that comes into mortgages. All right, so number 2.
High ratio mortgage insurance.
Okay, so this absolutely correct. that's what we're talking about today. We're talking about mortgage default insurance is what I'll call it, because sometimes it is high ratio and sometimes it's not high ratio. So I guess the general term that I'll kind of call it is mortgage default insurance. And mortgage default insurance is, like Dean said, it's the insurance that covers you guys probably don't even, maybe you do know, maybe you don't know, but it's the insurance that's there to cover typically high ratio or sometimes non-high ratio or conventional type deals. And what it does is it actually covers the lender in case the borrower defaults. So the borrower doesn't make payments. And so we'll talk about that today. And we'll talk about, of course, we'll talk about the kind of technology side of mortgage default insurance, because there actually is some technology stuff. We'll talk about the mortgage closing process, and we'll talk about how default insurance factors into that. And then we'll also get into a little bit about the various ways that we'll see mortgage default insurance as part of our applications. All right. So that is what we're going to cover today. But there is actually one other insurance that I typically think of that you guys might be able to also chime in on.
Title.
Nice. Dean's coming up with them all. So we've got title insurance. And there's going to be a fourth too. Do you guys want to know what title insurance first is? Do you want to hear what is title insurance? Yeah, okay. So title insurance is the insurance that essentially covers the title to the property. And sometimes that means that it could cover things like a person's right to the ownership of that title. So for instance, if you have title insurance and someone tries to fraudulently make a claim or some sort of a change to the title on BC land titles, then title insurance would actually fight the legal fight for you to get your rightful ownership back if it is changed. Title insurance would also protect against any deficiencies to title. So that could mean the property lines not being drawn in the right area. It could mean a neighbor encroaching upon your property, all that stuff to do with the actual physical location of the title. So that's what title insurance tends to cover. Now there's, very interestingly, and most people may not also know this, but title insurance is available not only to lenders. So typically when you fund a mortgage, you'll see that part of the cost of closing that mortgage will include title insurance, and title insurance is $250. Every time it's $250, it's just a set figure. But that title insurance protects the lender. Just make sure you note this, it protects the lender from title deficiencies. But you can also get borrower paid title insurance, so borrower covering, so it covers anything to do with that borrower, the owner of the title. And that's a separate cost, and you have to ask for it specifically. So again, check to make sure, see what your clients want, see what they want to spend, but title insurance is available out there. All right, so that's title insurance. Now, fourth type of insurance. Dean, you can't answer anymore. You've already got to. Lindsay, think about the insurances. What kind of insurance do you typically have to have when you're getting a house?
House insurance.
What's that?
House insurance.
Yes. Okay. So house insurance. So house insurance, or sometimes called property and casual insurance. So property insurance is the insurance that covers you in case someone slips on your driveway, or if your house burns down, or if you have a flood, or these kind of things. So house insurance, most lenders require house insurance, but again, that's not what we're going to be talking about today. We can have another episode on that because insurance is cool. It's very important, but all these different things come into mortgages. Just unfortunately, we're not talking about that one today, but we'll get there on another episode. Okay, so today we're talking about mortgage default insurance. And I'm going to go through a little bit about the technology side. So what kind of technology even exists on this mortgage default insurance? And you might be wondering, okay, hang on a sec. who is mortgage default insurance? So I wonder, what would be really cool is if I can do a whiteboard, share the whiteboard. I wonder, so, okay, we're going to go like this. I'm going to give you guys an early answer, which is that there are this number. Dean, I'm just printing really nicely for you. This number of mortgage default insurers. And so if anyone wants to chime in, feel free to answer so the name of one of the mortgage default insurers.
Genworth.
Okay, hang on. I heard someone say Genworth. Who was that?
Me. That was me.
Okay.
Now Sagin, right?
This is a prior correct answer. But as of today, Genworth does not exist. Do you know their current name?
Sagin.
Ah, thank you. And you said it right. No one knows how to say this. You'll see a lot of people that exist in the industry that'll say Sagin, and I'm like, don't ever say it as Sagin because that sounds really weird.
We had a speaker on it in our other class, and I think we were all calling it Sagin until he said Sagin. So now we know.
I know. It's got to be the worst name. Like, I don't know if they had put this through any sort of focus groups, but like no one knows how to say it. So obviously not a good title, not a good name. So the way I saw them say it is to go like this: Sage, and then with an N. So Sagin. Sagin is one of the insurers. And you're probably wondering why I put it as number 2. It's not because of rankings in terms of how many mortgages they do or anything like that. I'll tell you why in a sec. Okay, anyone else? Another mortgage insurer?
CMHC.
Awesome. Which stands for?
Canadian Mortgage Housing Corporation.
Yeah, awesome. I won't write it out because it'll take me the entire length of our time here. All right, so CMHC is another one. Third, last one.
Canada Guarantee.
Awesome. So Canada Guarantee. Okay, can anyone tell me why I wrote them this way?
The Sagin and Canada Guarantee are private, and the CMHC is government.
You got it. This is also spelled really weird.
Oh.
Spelled with a Y. True story. It is actually spelled with a Y. All right, so we got them. So CMHC, public insurer. It was started back in 1946, like we talked about last time. It was under a different name. I can't remember the gosh darn name. What was it called? I had it on the screen last time. I can't remember it. Anyway, doesn't matter because it's not called that anymore. It's called CMHC. It is Canada's only public insurer. It provides essentially the whole point of CMHC when it started was that it was there to provide housing for, or to put it another way, it is there to provide an opportunity for people to own their own home. So this is why, if you move forward to today, insurance does not apply to rental housing because it's not there to make you a slumlord. It is there to provide the opportunity for people to own their own home or to get into their own home. So that could be your second home, because you can't actually do it for that. But they will never allow you to kind of build a rental fleet or a rental portfolio. It is purely for people to get into their own homes. All right, so that's CMHC, Sagin and Canada Guarantee. So Bobby, you mentioned absolutely perfectly that it used to be called Genworth. Again, I think part of that Sagin comes from the Genworth part, and it's, I don't know. Again, focus groups would have really helped. It's not a good name, but it's there anyway. So Sagin is also there, and Canada Guarantee is also there. What's really interesting is that each one of these insurers, and this is the technology side, actually has their own website, which is cool because sometimes websites are good in helping us to find really cool stuff. I'm gonna go here. Okay. Okay, so you guys can see this. I'm going to start off with CMHC. Okay, so on the CMHC site, if you just do a Google search for CMHC, or you type in CMHC dot whatever, it's because it's a government organization, they do put the French version into their website. So it's CMHC-SCHL.gc.ca. Or just type in CMHC into your Google search and you'll find this website. So this is the main site. On here, it looks very basic. We've got a nice smiling fella here. Talks about professional resources and consumer resources. And then there's a bunch of kind of trending topics and some related articles. If you look at the top, you'll see that it's actually got my name on it. You can create a login on the CMHC website that will actually kind of start to drive certain types of articles. So like if you want to have updated articles whenever there's a new article that comes out, you can have all that under your profile. So that's kind of cool. So sign up if you want. If you like to read about stuff, that's great. If you're not like a detailsy person and you just want the kind of high level, don't sign up for anything because there's a lot. If you click the menu button, you'll see on the side here, there's a bunch of other things, but basically it's kind of the same as what you'll see on the main page. Some of the most important things that I find on this website is that there are tools. Again, a lot of these are consumer focused, and a lot of these are great to be able to download and to send off to your own clients. So you'll find that there's a home buying step-by-step guide. So if you click on that, it'll ask you if you want to submit your opinion on things. Okay, there's actually like a full-on step-by-step guide right here through the website, or you can download the home buying guides on the PDF. But it's really cool because they kind of walk you through a very basic process of deciding whether or not home buying is right for you. So just as a kind of like a thought experiment, why would someone, like for most Canadians, we kind of think I want to own a home, but what kind of people do you think wouldn't be like, this wouldn't be a good idea? Like, why would you not want to be a homeowner? Like, this is a full-on, like, I'm happy for you guys to just answer whatever it comes to mind, but why would someone not want to be a homeowner? What would be some of the stuff that maybe wouldn't be good ideas? Oh, I can't hear you, Dean.
Time.
I
Like for
still
work?
cannot. Oh, there you are. Go again.
Traveling like for work.
Right. So that might be one where if you're trying to buy something, traveling for work, and you spend a lot of time outside of the country, that might not be necessarily the best case. It might be expensive, or it might be hard to maintain. There's definitely some thought processes there. Anyone else? No other thoughts on this one. I'm just gonna, Brent wants to join and he can't find the link, so I'm gonna see if I can find the link here. There. Hang on 1 second. Okay. So there are probably a number of things that a person wants to consider when they're choosing to be a homeowner, but I'm going to go back to our, here we are, share this. Okay. So let's click on this and see what it goes out to. Here we go. Buying a home is a big decision. Ask yourself these 5 questions before deciding if you're ready. Am I financially stable? So think about a person who has jobs in which maybe they might be non-employed during a good part of the year, or perhaps they simply have a hard time kind of balancing out their finances for the whole year. So let's, you could think of someone who works perhaps in some sort of a seasonal industry. A ski instructor might have a hard time if that's all they ever do. They might have a hard time because they don't tend to make a whole ton of money. And in addition, they make their money in kind of 3 to 4 months. So that might be a person that has not necessarily financial stability. There's many other examples, but I won't go into. Do I have financial management skills? So again, discipline and managing your money. Same kind of thing that comes with that financial stability. Am I ready to and able to take on the responsibility for all costs? So things like a broken down dishwasher or a new roof. So all these things should come in. So that's, again, building up that asset base. And when we think back to like how we look at applications, not only do we look at a person's income, but we also look at their assets. Like we look at their net worth. How much in terms of assets do they have versus what they have in terms of liabilities? So that's, again, stability and responsibility. Can I devote the time to regular home maintenance? Again, this is that thing. So Dean was mentioning someone that works away a lot. Home maintenance is really tough because if you've got a lawn, you could easily, your lawn could grow like crazy. And if you've got really snoopy neighbors, they'll phone bylaw, and then all of a sudden you're getting tickets. And anyway, not good. So you need to be around for home maintenance. And new to Canada, there are some extra home buying things that are required by new to Canada, but again, can still be done. But again, tells you why you'd want to either buy a home or to rent. So again, this is just one little thing that we've explored on CMHC. There's a whole ton of stuff. This is kind of the consumer side. You can tell up here in the bar. You'll also see that on the professional side, which is what I would consider you guys, there's all sorts of other cool stuff in here, like housing market reports. This is the kind of stuff that I really like to look at because I like to see what things exist within their reporting. Housing market outlook. So they do prepare reports on their outlook. Housing supply. This is a really cool one to read because housing supply has certainly been down for very, very many years. And also kind of gives insights. I remember I used to come to the CMHC site to kind of get more details on things like average rents. So if you search deep enough into the professional side of their market insights, you'll actually find that there's a spot where they produce a rent roll per region. So it'll say in Vernon, the rent for a studio is this much, for a one bedroom is this much. And it's really cool to be able to look at that and say, okay, they're collecting data. We can kind of see what the average rents are in various regions. So that's kind of cool. So anyway, so that's one of the resources. That's the technology side of CMHC. Hello, Brent.
Hey,
all right, so let's get to, I'm going to go back to today, Brent, we're talking about insurance and specifically mortgage default insurance. All right, so I'm going to share this again with you. So I'm going to go switch over to Sagin. And in Sagin, there is, so again, the website is sagin.ca. Here, I find Sagin's actually really good for some really interesting webinars, and they've got a webinar series. The next one is, strangely, it'll be tomorrow, kind of just after the release of the Bank of Canada interest rate update. So that's available to you guys. It's at 12 p.m. Eastern, so that's 9 a.m. Our time. So you could certainly register for that. That's revisiting the counseling approach to customer care. So there, again, this is kind of like not really related to mortgage insurance. You kind of think, this really has nothing to do with insurance, but part of it is that soft side to dealing with clients. And so a lot of these things that you'll find on the websites will be kind of maybe slightly related to mortgages, slightly related to insurance, but as part of the entire process is there. And it also tells you about, here's the next webinar, which is on November 7th. And that one is new to Canada, which is also a really cool program. We know that in the next, in the next few years, Canada has committed to bringing in 400,000 new Canadians, new immigrants to Canada. And a lot of those people will probably go to Ontario, Quebec, and BC. So there's a fairly big opportunity there to connect with these people. And there are programs that are specifically devoted to them. So again, another cool workshop there. So again, this is the website for Sagin. Use it, find the stuff, find the tools and resources. Also tells you about how they underwrite, various tools and resources, industry insights. We're on the webinar site right now. We can also read a little bit about Sagin, but that gives you a sense of what they do. And then third is our Canada Guarantee. So look at this, they've been around since 2010, so a much newer insurer. But again, they also have lots of cool stuff like first-time home buyers workbook. They tell you about various things that they do provide in terms of mortgage insurance. Just a lot of neat little things that you can kind of work through here. So various different programs they might have. What's really cool about any of these, and this is kind of going to wrap up that technology side. So there's the 3 different insurers. But what's really cool about this is if you get good at learning these things and understanding the various the various insurer programs, you sometimes have an edge in figuring out how to structure a file, because sometimes underwriters don't know the programs as well as you might. So it pays to kind of educate. And so really look through these websites, get a good sense of what they kind of are and what they do. Maybe just read about one every week. Like say, hey, I want to go onto the website and I want to learn one thing about Canada Guarantee this week. Set that up as a goal and then just go through and start figuring stuff out. Again, every little bit that you can learn from all these various parts of the mortgage closing process will certainly help to enhance your ability to do your job. Okay, so we've covered the first part, which is the technology piece. I've introduced you guys to the website part of the various insurers. Do you guys have any questions on this? And remember, this is a roundtable, and I know you guys are probably going to have questions, and I'm just going to kind of barrel through in terms of how I think it might be interesting. But I do want you guys to ask questions and let me know if you've encountered something that you think is really cool or found stuff that's really useful. Not in my presentation, but just in general with these insurers.
CMHC, can you hear me?
Yep.
CMHC seems to be the most common name out there. Given that I think I've heard from some of them that they're regulated, the pricing is all the same. Is there really any benefit from going one to another unless there's been an issue with qualifying and you're trying to seek another source?
That's a good question. Is there a benefit? Like lenders, the various insurers tend to have niches. And it almost seems weird because you think that they're just all interchangeable, but some lenders will favor some insurers. Really strange. Again, I'll repeat that. So some lenders will favor some insurers. I don't exactly know why, but my guess is that it's because they've developed such a good working relationship that they can say, the files that we send your way, we know that they're going to fit your insurance profile. So it's almost like for us, we have certain lenders that we work really well with because we understand their lending profiles. We know that they want this kind of client. So if it's that kind of client and we know what their income looks like, we know what their net worth looks like, we know that this is going to work with lender A. Well, I think sometimes lender A says, hey, we understand exactly what the insurance profile looks like. So if these fit our lending profile, we're going to go to insurer A. And so that's why you get this. So for instance, with Scotiabank, we find that a lot of Scotia deals go to Sagin. They used to go to Genworth, but a lot go to Sagin. And I don't know why, but it just is very common for that to occur. Doesn't mean that they're all going to go there, but sometimes they do. And it also is that the lenders will kind of sometimes have a very niche type product or a niche type mortgage that fits with a certain insurer product. So some insurers will do A, B, and C, but they won't do D. So for instance, this might be a case where an insurer says, we're good with vacation properties that are off-grid. And you might think, what? People do, like lenders do vacation properties that are off-grid? Yes, there are some that'll do it. And in fact, they have to be insured. And so some insurers specialize in that kind of thing. And they have a kind of a list of here's what you have to do, here's the requirements. And so there's certain things that they just kind of will work through. So again, these are the kind of things that you'll learn if you kind of delve into these websites. But yeah, definitely they all kind of use various bits and pieces. Now, here's one little bit of, I think, common, or at least it's public knowledge that that kind of exists within the insurance world. And it's that not all insurers insure 100% of their mortgage amount, or sorry, it is the mortgage amount. So for instance, I'll put this, it's much easier to understand if you got an example. So let's say someone buys a house for $100,000 and puts 5% down. So it's a $95,000 mortgage on a $100,000 house. Obviously, we need to get insurance. So insurance will be placed. If it's CMHC, if that mortgage goes into default, then CMHC will pay the lender that up to $95,000. So they'll cover right up to 95. The other two, so the non-public, so the private insurers, they cover 90%. So if one of those mortgages goes into default, they'll actually only cover 86,000, not the full 95. So that's kind of the interesting part about public versus the private insurers, is that they actually do cover a smidge less, but it doesn't seem to matter. Their insurance premiums are all the same. The lenders don't seem to differentiate. They don't seem to care whether it's one or the other. They seem to, and I think generally the market prices all that in and says, you know what, they're all as good as gold. They're going to be fine. So that's kind of just another little tidbit. Do you guys have any other questions? Dean, did that answer your question? I think I totally went on a different tangent.
Is there anything specific to our area, like niches, that we should know? That
Can you repeat the question? Your mic doesn't come on for like 5 seconds.
Really? Okay. Can you hear me now though?
Yes.
Okay, sorry. Are there any things more local to our area that we should know for like one lender being better than another? Like if it's First Nations property or something like that?
Right. One lender or one insurer?
Sorry, if one insurer is better than another.
Right. I don't think that there is. Not that I've seen, but you bring up a very interesting point about the fact that we have Indigenous lands in this area, and it is much more tricky to get lending on native lease land. And a lot of those files will have to be insured. So typically they'll go through an insurance process. It's very tough to say. I wouldn't say that any one of the lenders or any one of the insurers differentiates based on that, but some insurers will have an appetite for certain types of native lease agreements, and others will not. So they'll kind of each have their individual lists. Lenders will also have their individual lists. It's a very complicated, unfortunately, it's a very complicated question, because I think a lot of it goes back to, what do the legal teams look at? Do they see anything within a lease that they're not happy with? They'll decide whether they like it. Same thing with the insurers, same thing with the lenders. So it's all going to be a very complex answer to the question. But in general, lenders and insurers tend to be very very homogenous in most urban areas. As we get outside of urban areas, things get a little bit more kind of, I think, more case by case. And again, your best bet for most kind of rural type properties is to look at national lenders. Typically banks tend to be a little bit more likely to do those scenarios. And when you do have insurance, that also kind of increases the desirability of it. So very easy to get mortgages in a very populated, homogenous area. So like the core of a city, easy, insurers are no problem. And then as we get outside the cities, you're more likely to get a larger lender because they can spread the risk more. You're more likely to get a larger lender like a national bank. That would probably do that. And if they've got insurance tacked onto it, they're even more likely to do it. Again, I don't know that I answered your question specifically, because this is like a very broad topic. All right. Any other questions on the technology side? Okay, so now here's the question then. If we've got mortgage insurance and we know what's going to happen, let's say we've got a 5% down payment. What is the mortgage insurance premium?
4%.
Oh, go ahead.
4%.
Yes. Now, how the heck did she know that? Bobby Lee, how do you know that?
Previous lending history.
Where are you finding your secret sauce?
There's a fantastic chart on CMHC too.
Right here.
I used to think it was just like you had to divine this by being in the industry for forever, right? Okay, so let's go back to screen sharing here. Okay, let's go back to CMHC. So Brent, what would you type in if I was at the CMHC site?
I'm not sure, Pete. Just try premiums. See if you can find it through there. Premium calculator, maybe.
Oh, look at come up with this one. Let's do that. Mortgage, loan, insurance, and premiums. Let's try that.
I'll probably get you. There you go.
There it is. There's our chart. So it's really strange that this isn't like splashed out on like the front page of CMHC, because I think this has probably got to be the most common question is how much does it cost? But it's here. If we do a little search, just like Brent said, if you type in the word premium, that works. We got our total premiums here. So this is where things get interesting, because like my big question at this point is, number one, who pays it?
The borrower.
This is Roundtable. Full on.
The borrower pays it.
The borrower pays it in some scenarios, and then the lender pays it in other scenarios.
Okay, so which scenarios? You've left too much of an open question here.
less than 20% down, and it's on the borrower. More than 20% down, it's on the lender.
Okay, so that's really good. So we talked about this a little bit last time when we talked about the history of mortgages and how the rates get all weird, right? Like, so between 65 and 85% loan to value, if you're doing a purchase and it's insurable, that's that weird insurable space, that's typically where the lenders will back end insure. So they'll pay for the insurance, but the rate is a little bit higher, right? So that's what's happening. So exactly what Brent said, the insurance is still paid, but the borrower doesn't see it. Now, the very interesting scenario is where the borrower actually has to pay it. So that's for the high ratio deals. These are the insured, not the insurable, but the insured deals, 5% to 20% down payment. So those are the ones where the borrower will pay it. So now the question is, does the borrower have to cough it up right away? Or what's the other scenario? How are they going to pay it?
It's financed in with their mortgage.
Okay. So what happens is so let's call it that the $95,000 mortgage. We can go back here to our whiteboard because I know Dean wants to see more of my writing. So we've got the $100,000 house. Borrower has $5,000 down payment. See, the rating's getting worse, Dean. We've got a $95,000 mortgage. So in this case, what is the insurance premium? Percent? You guys have to call it out. I can't do all the work.
4, Pete.
4%. 4% of 95 is?
3,800, I think.
Okay. So 3,800, we'll call it. Okay, we'll just do 3,800. So then the total mortgage is how much?
98,800.
98,800. Okay. So just as Bobby Lee said, the amount is added into the mortgage. So this becomes the total mortgage right here. And then the payments are based on this amount. So if we were to go into velocity, you'll see that it's not that we take 95,000 and figure out the payment on that. It's actually the 98,800 and the payments are based on this. So it's slightly higher than if the mortgage were simply 95,000. But the true benefit of this whole scenario is that the borrower does not have to cough up the additional $3,800. Now, I always have a quick, like, I'm always all about the questions. So my question was, when I first started in the industry, what if the borrower wants to pay the $3,800? And the answer is the borrower can pay the $3,800 if they really want to, and they actually have the resources. They can pay that up front and then just have their payments based on the $95,000 mortgage. But if a person only has 5% down, typically they won't have that additional 4% sitting around. So that's typically why it gets tacked on. All right. So that's very simple. That's very easy to understand. So as part of this mortgage completion process, we know that anytime we see a mortgage where it's an insured mortgage, so anywhere less than 20% down payment, we need to tell the borrowers that this is what's going to happen. You're going to see a mortgage insurance premium, and you'll actually see it tacked on to the mortgage. You'll also see it tacked on to any disclosures that we make. So as part of this process, as the completion of the mortgage, we're going to disclose to the clients what has actually been added for insurance premium. And as part of the discussion with them, we're going to let them know that there is mortgage insurance premium, and the premium is there to ensure that if the mortgage is in default, that the lender will get their money. That's it. Again, part of that honesty bit. Here it is. We're disclosing it. This is what's happening. You get into a house for fairly cheap, but because of it, you've got to pay a premium. All right, so if you guys want, I'm going to go into Velocity here real quick, and I'll show you within Velocity where you'll see this insurance bit, because a lot of times people want to know where this appears. All right, so if you go into Velocity, you'll have your main screen. I've already opened up a very simple, my usual test application for Mickey Mouse. All right, so within this, we're going to go into the mortgage request, because that's where all the mortgage stuff happens. And just a quick show of hands, you guys can use the reactions. Do you guys all use the modern view? Sweet. You can, I don't know if there's a poo emoji in part of these, but if you can find it, put that up there too.
I use the modern view unless like something's bugging me up from validating the file. Then I flip into classic just to give me the different perspective. I think you and I went through that one time. Just
yes.
But traditionally, yes, I'll work in modern view.
So this is really weird. And I know you guys will, I hope you guys have never had to encounter this, but when you encounter a scenario where you can't find something, or something just doesn't appear where you think it should appear, let me know, or let Brent know, because he's volunteered now. But contact us, because oftentimes we'll go through one of these applications and we'll find a scenario where something appears in one view and it doesn't appear in another view. And it's really super weird, very strange. It should not be, but sometimes there's still quirks in the system. So again, switching up here from modern to classic sometimes helps. And sometimes it's just in how it's viewed. I don't exactly know why it doesn't translate, but modern gives me virtually 99% of everything that I need. But like Brent said, there's the odd scenario where you can't find it in modern. And I don't know if it's because we're not looking in the right spot or what. But anyway, if you encounter a spot where you're like, I don't know what's going on, give us a shout. But anyway, modern view, simply go to mortgage request. And seeing as though we're kind of talking about the mortgage completion process right now, I don't know if you guys have taken the time to fiddle with the way that your various tabs read here. I have mine all collapsed whenever I open a file. These are all collapsed so I can see exactly what each header is. But I typically go through, so this is me going back to history. I will set this up just like I would if I was taking a paper application. So I have borrowers first, then I have a list of their assets and liabilities. Then I figure out what is the subject property that we're dealing with. And then I figure out, okay, now that I know what the subject property is, what is the mortgage that I'm looking for? And once I've got the mortgage figured out, I say, okay, what kind of stuff do I need to support that? So that's kind of why you'll see my top 5 is in that order. But anyway, mortgage request, just a little more insights into my brain. They might make sense to you. It might not. Brent?
I think that's one of those things that people, as you get comfortable with kind of how you're talking to people, you kind of tailor that to how your conversation goes. Like my order is very similar to Pete's, and I know that's because as I'm talking to somebody, that's the order I'm asking them questions about things in. But as you go and you develop your own kind of flow to things, then maybe that's a little different. And you want to kind of shift where sections are and that type of thing. It's just one of those things you can really personalize to you as you develop kind of your own style with things.
Exactly. And it is interesting because it makes sense to me, probably because I did paper applications a long time ago, but it doesn't have to be this way. And that's the beauty of this modern view, is that you can kind of flip things around to wherever you want them to be. So anyway, just know that you can kind of fiddle around. So under the mortgage request, you'll see that I've got a couple of mortgage requests. I'm just going to go with this private one. That's my second mortgage request. In here, you'll see that we've got a purchase price of 500,000, 100,000 down payment. First off, is that going to require mortgage insurance? No, definitely not, because it is 20%. So as soon as we hit 20%, no longer requires. Is this insured? No. Is it insurable? It's a purchase. I'm going to call it a purchase.
Can you scroll
down? It does
down
say purchase here.
Amortization.
Sorry?
What's your amortization on that, Pete? I can't see it at the bottom there.
Gosh, you're getting into the details. Just based on loan to value alone, is it insurable?
Yes.
You asked if it was insurable.
He's so good. All right,
Brent, you need glasses.
So, I really do.
Maybe I can upsize the font on here. No worries. But indeed, 20%, it's a purchase, so it is insurable as long as we're 25 years or less in amortization. So that's good. Good note. But let's adjust this. Let's make this 5%. You'll see that it changes the number in the down payment. So as soon as I type in 5% here, it changes this down to 25,000. Mortgage here is 475. You'll see that the total mortgage in the big blue font down here has not changed. And the insurance premium itself has not changed. Anyone tell me why?
You haven't clicked insured.
Right. So strangely, it doesn't automatically say that if you do a 5% down payment that it's going to be insured. It doesn't automatically know. So you'll see right next to this line where we've got the first mortgage, there is a checkbox that in very small font, and I'll probably get a magnifying glass for Brent here, that it says insured. So as soon as I click that insured button, boom, there's our 4%, 19,000, gives us a total mortgage of 494. So that's where all the magic happens. It happens right there. And you'll see that there's actually a little box down here below that talks about insurance. So if I uncheck this, the box disappears. Check the insurance box, we actually get a whole new section that simply talks about insurance. So first box is insured, second box is include insurance. Remember how I was saying that a person could actually pay for the insurance if they wanted to? That's this second button. I unchecked include insurance, and look at our mortgage goes back down to 475. Click insured, include insurance, and we're back up and includes the insurance as part of that mortgage. Now, here's where things get super interesting, because we can actually select which insurer we want. Now, I'm going to put a little word of caution in here. This is purely a request. It does not obligate the lender to provide you with that insurer. The best way to do this, if you know that for whatever reason, you need to have CMHC on a particular file, then you can go ahead and select CMHC. But the most important thing is to connect with the lender. So that could either be talking to the lender rep or the underwriter, and diarize in your notes exactly why you're requesting that particular insurer. Because if they don't know why you're requesting it, chances are they're just going to ignore it. But if there's a particular reason, so here's one reason that it might have that you might want to request a particular insurer. If for whatever reason you had a submission that was made and it was sent to an insurer, let's say it was sent to Sagin, and Sagin said, no, we decline this file, maybe because of how it was structured, then what happens is that lender can submit a second insurer, but they'll only do 2. Just know that lenders will only go twice. You can only get 2. So it's not even like baseball. You don't get 3 strikes. With lenders, you only get 2 strikes. So if for whatever reason Sagin declines a file, then what you can do is you can select either Canada Guarantee or CMHC, and you can submit back to the lender and say, hey, can you try this insurer? Maybe there's some sort of a restructure that you have to do. Maybe there is the addition of a co-borrower or an additional applicant. Something maybe changes, but we're going to send it to that new insurer just to do another application. That's totally fine. And that's the reason that you might want to request a particular insurer. But most typically, people don't request an insurer. Another scenario in which you might select an insurer is one where a person is trying to port a mortgage from one property to another, and you're trying to port the insurance premium as well. In that case, you would specify that this is CMHC insured and that we're requesting it to be CMHC insured in the new place. So that's kind of what you're doing there. For the most part, though, I just leave it blank. And what's really cool, getting back to that whole chart, is that this will actually show you in the premium rate what the premium percentage is. So here it shows us the 4%. Trust me, Brent, it says 4. He's never going to live this down. Premium is 4% on that 5% down payment. So that's cool.
I can't find my glasses. That's the problem.
They're lost in the move. Oh no.
God knows where they are.
Oh man.
Pete, just to touch on that insurance button for a second. It's such an important thing as you're going through the process, if you know it's insured, to make sure that button is ticked, because that'll impact your ratios. So if you're trying to figure out exactly what somebody can afford, you really want to make sure that button is actually ticked and you're not basing everything off of the amount prior to the insurance premium. So it's a super, super important feature.
Not only is it important for that, but it might, by selecting that button, it will, I think does it negate a 30-year amortization? I think it will. I think it'll say, no, you can't do 30. I don't know. We should test that. Yeah, sure. But it doesn't know. I think it does. But even that little bit of extra insurance premium, especially at 5%, it makes a big difference in terms of how much is calculated on a monthly basis. So here's another question when we talk about insurance premiums, and I'll put this out to all you guys. What is the maximum gross debt service? So that's the mortgage part of the calculation. So property, so we're talking about mortgage payment. We're talking about of course, the insurance included. The mortgage payment plus heating plus property taxes. So the GDS, gross debt service, what is the maximum number percentage-wise that's allowed?
44. 39.
Oh.
39, yes. Okay, so 44 is the answer to the next question, Jamie.
Oh, okay. Damn, I'm gonna write those down.
39 is the mortgage component. It's the property component. The gross debt service. The total debt service. So this is kind of how I always remember it. Is that gross? You kind of think, well, I don't know, what does that exactly mean? But you know that total, so we think of TDS, total means everything. And so therefore, that's always the bigger number. So total debt service is the 44. And then the next question is, can you get an exception if you got 44.01? Good. The answer is no. There is no exceptions on insured deals. Find more income. So as the famous quote goes from the south of the border, find more votes, or in this case, find more income. So that could be, that could mean we're looking at the exact amount of income. So if a person is salaried the exact income is this, but do they get a bonus? What if they have Canada Child Benefit? Do they also have pension income? Do they receive any other sort of income? So you can look at their tax returns, you can look at their pay stubs, their statements. If there's some way to kind of get them back down, so that 44.01, back it down to 43.99, then you're in business. But 44.01, no, not going to happen. Insurers do not allow exceptions. All right, so that's on that side. And Dean, yes, you got the right answer. So 39.44 max on insured business. All right, so we talked a little bit about technology. I give you guys some websites. We talked about the mortgage approval process and how this insurance bit fits into the various things that we use, the application system. I was going to leave the lender bit to a very, very simple discussion, which is perfect because we don't have much time. So in terms of lenders, which lenders, and in three broad categories. So if you guys remember the three broad categories of lenders, which lenders will do insured business?
A lenders.
A lenders, right? So prime lenders, those are the only ones, those are the only lenders that look at insured business. So if we're going to a B lender, so for instance, let's say we're doing a kind of a stated income product, or a product where there's something funny, maybe the person's had credit issues or whatever, those things are not going to fly in the insured space. And if we're looking at private lenders, not going to fly in insured. So typically, if we're thinking about loan to value, we're below 80% loan to value for anything that has no insurance. And that's going to be the B lenders, the alternative lenders, the private lenders, all those not going to deal with insurance. So that was really in terms of the lending side of things. Remember that these files that have insurance are all going to be with the prime lenders. All right. That's today's topic. That's